Hello there, and thank you for tuning in. You're watching the Swatantra series on ET Now. I'm Faye D'Souza. This is an investor education initiative. We're going to take you through the art and the science of investing and help you become rich over the long term. Remember, there is an email ID at the bottom of your screen. You can also reach us on Facebook and on Twitter. If you have any questions at all about investing your money, or if you'd like to join us in the studio on any of our shows as we travel across the country, feel free to get in touch with us. I have a wonderful audience of investors in the studio with me today who are going to ask questions to our two panelists, and we're going to talk about the basics of investing our money. In the studio on the panel with me, Vishal Kapoor, Wealth Management at Standard Chartered Bank. Thank you for joining us, Vishal. And of course, Mr. Suraj Keli, he's the Group President Sales and Marketing at UTI. Gentlemen, thank you so much for coming in. I want to start at the absolute basic, Vishal, because this is the first episode in the entire series. So if we start at any age group of any of our viewers right now, what would you say is the first thing we should do when we start investing our money? Because a lot of times we look at, okay, maybe we should get a fixed deposit or a recurring deposit, but that's not always it, is it? We should start perhaps with a contingency. What would you recommend?
That's right. I think if I can step to the stage even before that phase, what we know is that Indians are great at saving. We have among the highest savings rate in the world. But we are not that good at converting these savings and putting it to work, which is where it becomes an investment. And I think that's the first step, to start looking at your savings and putting it to good use. And once we get to that stage, we can then look at, how much money do I need to keep aside for an emergency, which becomes a contingency fund, typically a few months worth of your expenses. What protection do I need? And some of these are basics. And then if there is any surplus savings left over, how can I invest it in a manner that it stays secure but is able to beat inflation over the long term?
All right, so I'm going to take you back to what you said before we move any further. You said the difference between saving and investing. Now, technically, if in the very most basic form, I'm looking either at a bank account, a bank savings account, and a fixed deposit, how do I tell the difference between what is a savings instrument and what is an investment instrument?
Okay. I think clearly, as the name suggests, a savings account is to save. So, if you have an income and you have an expense, whatever's left over is something that you save. And that's a savings account is a very good way to try and do that. While you are saving, the bank does pay you an interest on that, so it's a good return on, or a reasonable return on that saving. But that's not going to be enough. Why? Because there is inflation that is much higher than typical savings rate. And that's when you start looking at how do I beat inflation, how do I get my money to grow at a faster rate. Now, fixed deposit is a very popular way for most investors to get started because it's simple and it's typically just saying, okay, if I lock in my money, I get a certain rate of return, and that is an easy way to start. But again, in the long term, is that the only thing, or are there other avenues, is something that I know in the course of the series, I'm sure you'll get a lot of discussion on.
So if I can just put this in a nutshell for our viewers, if I'm beating inflation, that's an investment. Would that be fair to say?
Absolutely.
All right. So Suraj, tell me this. A lot of our younger viewers write into us on a regular basis saying that, okay, I'd like to start investing for the next 3 years or for the next 4 years. While it's important to start young, tell us why it's also important to look at my entire working life as a time horizon. So I'm investing for the next 20 years or the next 30 years, depending on how old I am.
If you start working at, let's say, 18, right, and you save till age 58, you've got 40 years of working life, right? Now, in that 40 years, what you do with your money, where you invest, and what rate it grows is going to be the essential difference between whether you are wealthy or you're not wealthy. So let's assume you can double your money every 5 years, right? So you'll have 8 time periods of 5 years each. So 2 raised to 8 is 256. So if you invest 1 rupee and leave it for 40 years, it grows to 256 rupees. Now you can do the math. You save a crore, you will have 256 crores. You save 10 lakhs, you will have 25.6 crores. So the magic of compounding, right, really takes place if you can save for a longer term. So when I meet younger people, I tell them, look, if you can forget some money for a longer period of time, that's where the magic is going to happen. But if you come with a 3-year horizon, I think you're not going to get too far by the way.
Vishal, I always come to you when we're talking about asset allocation. Again, in the most basic sense, as Indian investors, we look at three large buckets. We look at the fixed deposit or the PPF, which is a debt investment. We tend to always love gold and always love real estate. Possibly, and at great risk, ignoring one of the most efficient forms of investment, which is equity. And if you talk to a first-time investor, they'll always tell you that it's so scary, you tend to lose a lot of money. Tell us how, if we combine the advice we've gotten so far and look at a long-term horizon and actually consider equity, in history, equity is not as risky as people think it is it?
That's absolutely right. And I think, and that is the great opportunity in front. Firstly, as you rightly mentioned, we do have a passion for fixed income, real estate and gold, when actually much of the data tells us that it's equity that has provided the best inflation beating and risk adjusted returns. So one is, how do you get a bit of equity? And that's where I think the mutual fund comes in, because that's the very efficient way for first time investors, for investors who are not going to be able to devote a lot of time doing research, etc., to participate in equity in a very efficient manner. So absolutely right. I think, and the data in India just shows that very, very starkly that there are funds with almost 20-year track records now, which have beaten Suraj's compounded rate of growth by a healthy margin. So they've returned 20, 21, 22% compounded over 20-year periods. That's significant amount of wealth generation. So definitely that's an asset class that we should almost risk being out of at our own risk.
All right, you have a question? Go ahead.
Yeah. You said that mutual fund is risk-free. Now, for me as a challenge, there are lots and lots of mutual fund schemes available. Now, for a 50,000 amount or a 1 lakh amount, I'm not going to hire a certified planner to detect which scheme I have to invest. So how does a retail investor choose that? Problem with equity and mutual fund is there are few good performing assets, but there are a lot of non-performing assets. So in that case, what happens? Fixed deposit is a good safe that I don't have to use my brain, just park it, and I'm getting 8%, which will be taxed, etc.
So we have two questions here. I'm going to split that up. First of all, Vishal, and this is the bigger problem, the fact that either investors feel that the advice is too expensive or good advice is too expensive, and then I have to go out and do it on my own, which seems like a daunting task, and we'll come to that in a bit. But how do we approach, and this is also tied up in regulation, the fact that who's an advisor, who is a distributor, who's allowed to tell me what. If I am a regular investor who has 5,000 rupees to put aside every month, where can I seek advice and how should I choose that advice?
Okay. I think before I answer that, I just want to clarify, I'm not saying that mutual funds are without any risk. So let me just clarify that, because that's where you started. Mutual funds are, they bear the same risk that equity bears. Obviously, they manage it in a different way, but we can cover that in due course. I think coming to for your question, a very pertinent point. Firstly, I don't think the notion that for accessing an advisor, you need to be really a very large investor or you need to commit a certain amount, etc., is necessarily true. I don't think that's true. There are advisors available in very, very different shapes and forms. It could be the neighborhood sort of IFA, as it is called, which you can access. It could be a bank that you can access. There are financial services distribution companies, big names, that have offices that you can access. There is a slight difference between an investment advisor, which is a regulated entity under SEBI, and a distributor of a mutual fund. You could choose either. An investment advisor will charge you typically because they're providing professional advice which is more holistic. A mutual fund distributor will offer you a few schemes and help you choose a scheme based on performance. End of the day, like with any other service, I think it's experience and trust that builds up over time. I would strongly recommend that just for that fear of should I or should I not, give it a try. It's a far better outcome in the long term than not doing it and keeping your money in fixed income for a very long period of time.
Suraj, I want to very quickly ask you the second question that he had, which is picking a mutual fund because I don't want to pay for the advice, so now it seems like a daunting task and now it seems like a lot of risk, and we do have a market that's overrun with choices at this point. So if I'm going to make a simple choice, how should I choose that one fund?
Well, I think, where you start really, when you're building up or deciding to invest is starting with a time horizon to begin with. And second question which you ask is, am I willing to take a risk on this money that, how much loss can I really bear? Because these two questions really will determine what category of mutual funds you are going to choose from. So typically in India, we think mutual funds are all equity, right? So they're very risky. But we also have bond funds, we have liquid funds. So we have different categories of products, so which have lesser risk as compared to equities. So here, for example, obviously you are wanting to invest for the long term. So equity is a great starting point. And, just to illustrate the Sensex, which had a base year of 7980, started at 100 and today is 28,000. So had you just replicated the index, right, you would have multiplied your money significantly. But the problem is that once you start investing, you're not really saying that, okay, let me replicate the index, let me beat the index, and let me buy the best category mutual fund. So the point here I have is that if you get into equity as an asset class, and typically if you were to buy, companies which invest in large or, big names, the chances are that you will replicate or do better than the index. And that itself is a great move forward. And it's not about whether I got 2% higher or 2% lower, because equity as an asset class would beat bonds, by 9 to 10%. So that itself is a great move for you. So you should not be too hung up about did I get the best product. The other way to do that is that there are mutual fund rankings, so you can go to independent research entities like CRISIL or Value Research, and from those star rankings, or CPR rankings, you can easily find out which are the better performing funds.
One of the things that you should keep in mind when you're investing in mutual funds is what they tell you in the ad. A, that it's subject to market risk. Secondly, that past performance is no indicator. So if you're going to invest for the next 10 or 20 years, you want to look for a track record that goes back 10 or 20 years and not something that's only done well in the last 1 year. Unfortunately, we have to take a very quick break, but there are a lot of questions from our audience. We're going to come back and answer more questions about the basics of investing. That's on the other side. Don't go anywhere. Welcome back. You're watching the Swatantra series on ET. Now we're talking about the absolute basics of starting a portfolio and investing your money. And our audience in the studio have a lot of questions. The gentleman in the front, you have a question? Go ahead.
Is it SIP is the best option for the people like us who don't understand which is the best mutual fund?
Okay, so there's a bit of a confusion here as well. One is choosing the mutual fund, and SIP is just a mode of putting that money in. So it's a systematic investment plan where you put in money on a regular basis instead of a lump sum. The choice of the fund that you're investing in is a completely different decision. So
No, but I understand because SIP is like a bunch of mutual funds. It is a high risk, high growth. It's a combination of both, which suggests most of the financial planner as well as the banks also. So that's what, this is my personal experience.
SIP is a means to invest. And I think even before we get into an SIP or a mutual fund, it's very important to understand a bit of the basics and your own appetite for risk. Let's keep in mind that mutual funds are really a pool vehicle for different asset classes. You could very well be buying a fixed income product, which is still a mutual fund, or a gold linked product, which is also a mutual fund, or an equity product, which is also a mutual fund. Now, fundamentally, since we know fixed income being similar to fixed deposits, gold being gold, they are completely different vehicles altogether. So the first thing is, a mutual fund in itself may not be good or bad. It's really a particular portfolio or a scheme, which is what we are talking about. Now, coming to, therefore, the first step to do is assess what your risk is, and therefore, what is the right type of asset first that you want to get into. Right? So if you cannot afford to take the risk, if your horizon for investment is short term, it's more likely that an advisor or someone will suggest that don't get into equities. A fixed income fund is the right vehicle because it may have advantages over some other fixed income products. But if your time horizon is longer and you can take some amount of more risk, then someone will suggest let's look at an equity fund. Now that suppose you've come down to an equity fund, then the choice of equity fund starts up. Can get confusing Because someone may say large cap, mid cap, someone may say this fund versus that fund. And that's where the choice of fund, and like Suraj mentioned, maybe some professional help or online help or ratings available may be one way to go. And then we come to how much money to invest. Do you want to put a lump sum, which is like putting your annual bonus in? Or do you want to save every month and keep putting a part of that money, almost like we do in a recurring deposit, right, into a fund? That last one is the SIP, which is that every month you say that out of my income, I have some expenses, I have some savings. Part of that savings I want to put into a systematic investment plan, which is what a SIP stands for. That plan could be in one fund or it could be in many funds. It's your choice. So what you could be doing is you've decided you want to buy some equity funds. You select maybe 1 or 2 or 3 or maybe 4 funds and then have an SIP. That is a way to start investing into those funds, which makes it very affordable and convenient.
But Suraj, I'm going to ask you, when I choose a fund and I look at the performance, ideally we should be investing for the long term. After a year and a half or 2 years, if I'm not impressed, how do I decide whether this fund performance has been impressive or not? Should I hold on to it? Should I not hold on to it?
Yeah, no, I think that's a great question because, I think in investing, the biggest problem is that, you will have a situation where you bought a product and that doesn't seem to be doing well. So the first, the way I would really answer that question is that if you're buying into an equity product, don't evaluate over a 1 year period. I think it's too short term really to look at it. I think because any investment strategy, plays out over 3 to 5 years, right? So I think first of all, if you're going to evaluate every month, I think you'll be more disappointed in life and chances are you'll end up switching at the wrong time. The second part of the question here is, I think the part on SIP, I can't really resist but answer some part of it because most of us actually even struggle to, start saving in the first place because the way we think about savings is I've got an income and then I've got some expenses and whatever is left, that's saving. Now in an SIP, what happens is you actually change the equation. Here's your income, then it's your saving, and then whatever is left is your expense. So the first step to generation of wealth, which is that are you doing adequate saving, starts up with an SIP, and hence it's a great idea to do an SIP, right? Because in the first place you'll be able to save, and then comes the next part of where do you invest that money.
All right. We have a question from the gentleman in the back. Go ahead.
As a layman, what I wanted to know is that what you said that the 100 Sensex has become 28,000. So do you suggest for a layman or the first time investor to put it in like an index fund or Sensex fund, where we are getting the basket and we need not to track it because if we are bullish on the India, then automatically we are going to beat the inflation and we are going to get some decent return. So what are your views on that?
Yeah, no, that's again a great question because index investing is very popular in the Western countries, especially US and UK, and a lot of first time investors typically start up with the index. But I think the situation in those countries is that the actively managed funds, underperform the index, so index becomes a great investment. So, but in India, what we have seen is that most of the equity funds have outperformed the index and by a very significant margin. So the view here we take is that it's better to be in an actively managed fund, and so I think from an Indian situation, I'll recommend that you be in actively managed funds over an index. But obviously, if you're a first time and you just don't want to track or choose a fund manager, index is a great place to start.
Vishal, in terms of our index funds and our ETFs right now, are we as efficient as we could be in India?
I think we are more or less there. As in technically, there may be a few basis points that you could improve upon, but again, it is a few basis points, which is 100th of a percent. So is that a material difference? Not really. It is an efficient way. But like Suraj mentioned, the evidence so far is that there is large outperformances that Indian fund managers have managed, and therefore there is value in active management. But if you want to keep it simple and you don't want to listen to experts every few months to say is this a good fund or not, why not? It's a good way to at least participate.
All right, I'm going to take another very quick question and then we'll come back after the break. Yes, go ahead.
As an investor, what is the homework which I need to do personally? Do I need to dig deep inside the balance sheet of the company, or do I need to study about the fund manager, how good his performance is?
I think we tend to, as investors, it's very natural that we tend to spend a lot of time trying to select the best product or the best fund. but there is some good research and data that has been looked at across many markets, including a seminal study in the US many years back, which said that your actual performance of portfolio eventually is not going to be as much based on the specific product that you chose, but on all the other factors that we just spoke about, which is when did you invest, how long did you keep it invested, which asset class did you choose, and that which asset class and the balance of that asset class has the predominant input into your final product performance. So my point is that sometimes we can get so carried away with this fund is better than that fund because technically it may be better by a few points on a very complex ratio. Is that why you invested in the fund? The answer is maybe not. If that fund is meeting your objective, you should be happy, right? So I think it's important to go back to basics and say, look, why am I investing? What is the tenor? Am I investing enough? Am I going to meet my goal? And if we do all of that, we should be happy.
All right, we're going to have to take a very quick break, I promise, but we'll come back and answer more questions from our audience on the other side. Don't go anywhere. Welcome back. You're watching ET Now. This is the Swatantra series. It's an investor education initiative, and we have investors with lots of questions, so we're going to get straight to it. The gentleman in the front, yes, go ahead.
Hi, I'm Sandeep Saraf, IT cloud specialist from Bombay. Now, my question is, before I start investing, I have selected equity as a class to invest. But how do I select mutual fund? How is it better than investing individually, or I should go the PMS way? So how is mutual fund better than an individual investment or a PMS investment?
Do you want to take that, sir?
Yeah, so I think that's a great question, and let me start. Suppose you're starting with an X amount. Typically you need a large amount of money if you want to invest directly in equity and create a diversified portfolio. So mutual funds, what they do is actually they enable you to pool your money with investors with similar interest, and then you can hire professional services to really manage that money. So you get the services of a professional. You can start investing small amounts of money. There's a lot of transparency. You will know every month where the money is invested. You can track the performance. So there are plentiful benefits of coming through a fund. And so building a diversified portfolio and with expert advice at a rate of 2.5%, I think that's a steal, right? So mutual fund obviously is a great start to make an investment.
If I am not having 10-20 lakhs of rupees to start off with, and I want to invest regularly, it makes sense to invest in mutual funds.
You don't have a choice. You'll have to only go to funds. If no PMS will take lesser amounts. So
no, so I have this basic example for you. Today you've probably in the office and then you've come over to our office. Have you had time to check the stock market? Have you had time to check your stocks? But if you had invested through a mutual fund, you have a fund manager whose job it is to constantly monitor your investment. And he's top of his class fund manager if you choose him correctly. So that's what it means. When, by definition, a retail investor is at work when the markets are trading. The idea behind using a mutual fund is to choose a fund manager to do that job for you. But Vishal, the concept of PMS keeps coming up in comparison to mutual funds, and while the ticket size might be drastically different for the two, tell us from the point of view of just execution and returns why one should choose a mutual fund and who should choose a PMS, for example.
I think PMS is at one level a more evolved, a more sophisticated, and to that extent a more can be a bit more risky because it is taking more concentrated bets than a mutual fund. That's at a very basic level. The essential difference is in a mutual fund, you're giving the money to a fund manager. That fund manager is pooling money across thousands of investors like yourself who have a similar objective and managing that money for a fee. In a PMS, you're giving a larger sum of money to a very specific fund manager, obviously an individual or a company. There are lesser number of people like you, and your portfolio is different from that other person's portfolio. So your portfolio is very differently managed. You hold the security, which is the stock, directly in your name versus holding a unit. Now, when that happens, what we typically see is that the strategy that you have in mind can be implemented better, provided you have a strategy in mind. So it becomes more specific, more exclusive for you. And typically investors who are slightly more sophisticated, more experienced, who have some ideas about that's how I want to invest, will therefore go to a PMS manager and saying, I may not be wanting to do it every day, so you manage the money, but manage it to this strategy. So larger investors, more experienced investors, and therefore can take more risks than a mutual fund will typically take.
All right, unfortunately, we've completely run out of time on this episode, but quick learnings. Keep it really simple. Start as early as possible. Use an SIP, use a mutual fund, invest for the long term. And you must have equity in your portfolios. Remember again, you can reach us if you have any questions at all about investing your money. We're going to be here on Swatantra for the rest of the year, helping you with your investments. Vishal and Suraj, thank you so much for spending time with us. It's been an absolute pleasure. We've all learned so much. Thank you so much for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का. Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.